Greetings, members one and all of the Salivation Nation. Gold is continuing to take a beating. It is tallied the 7th straight drop, which marks its lengthiest skid in 2 years here, according to this article from Market Watch. Yes, it's suffered the longest daily losing streak for about 2 years. And we're going to explore some of the reasons why in this article from Market Watch, and some positive news we're going to look at as well. Let's explore. Yes, this comes to us from Market Watch. They're saying that gold futures finished lower on Tuesday to tally a 7th straight loss, the longest streak of daily declines in 2 years, as strength in the dollar and a lower economic growth forecast for China dulled demand for the precious metal. The key reason for gold price to fall is China, said Chintan Karnani, chief market analyst at Insignia Consultants. There is apprehension that a slower Chinese economy will translate into slower pace of gold demand. China lowered its growth forecast to between 6% and 6.5% this year. Now, that is a little bit strange, because usually we would expect the opposite to be true, because when the economy does well, typically that is when the gold price goes down. But in this particular case, China's economy is not doing as well, and the price and the demand for gold is going down, hence the price of it going down. And that is quite an interesting metric to measure in China. But keep in mind, in the East in general, typically there is a cultural demand for gold. So if their economies don't do well, that could offset any suppressed economic activity in the West for rising gold and silver prices. Moving ahead, however, the fall in the gold price is just a correction and not a bear trend, Karnani said. A bear trend in gold will be there if gold continues to fall after the release of the U.S. non-farm payrolls on Friday. So we will see what that report indicates. April gold fell $2.80 or 0.2% to settle at $1,284.70 an ounce, with prices based on the most active contract again finishing at the lowest since January 24th, according to FactSet data. A loss Tuesday for gold marked 7 consecutive losses, the longest stretch of declines since the 9-session fell ended March 10th, 2017, according to Dow Jones market data. Gold prices had tapped session lows as U.S. dollar strengthened a bit on the heels of data of new home sales and the ISM non-manufacturing index. New home sales were at a seasonally adjusted annual rate of 261,000 in December, up from 599,000, while in the ISM services survey jumped 59.7% in February from 56.7%. The IHS Market final U.S. Services PMI was at 56 in February versus 56.2. The dollar, as measured by the ICE U.S. dollar DXY index, was up 0.21%, up 0.2% at 96.839 as gold futures settled, making gold less appealing to investors using another currency. Another member of this community had talked about to check out if it goes to 97, and that's when the time to kind of watch and see, and that gold can continue to fall. Tuesday trading hasn't seen aggressive gold demand as prices have not shown signs of a bottom, said Karnani, but the metal should see good demand from Wednesday and for the rest of the month. Chinese gold demand should also be good, as a reduction in the trade war will be demand positive and not demand negative, he said. Brexit and worries about the global economy and U.S.-China trade are long-term positive factors. For last week, bullion fell below the closely watched $1,300 line and lost about 2.5% on the week, the sharpest weekly fall since August. Broad risk on sentiment, which boosted U.S. and global stocks, as well as strength in the U.S. dollar, worked to dull demand for the haven precious metal, and then again to start the week. And you'll notice that because of the interesting things with China affecting gold, we didn't see quite the amount of drop with the same drop with silver. So I thought that was kind of an interesting side note there. Some weakness in the stock market, however, likely to serve to limit losses of the haven metal. U.S. stock index has traded most of the lower Tuesdays as investors continue to keep an eye on the development surrounding U.S.-China trade talks and China's domestic economy. And that's kind of what is the thing to kind of keep in mind. Because like I said, they can kind of push and pull against each other because a bad Chinese economy in turn could cause some issues in the West and other places with trade and the like. We'll see how that all plays out. Here we can see the chart for gold over the past, since the beginning of the year here. Very interested to see how high it went. Now it's back to kind of where it was, really close to the beginning of the year. Very interesting. Silver settled flat at $15.10 an ounce. And then copper finished up 0.96%. Platinum lost at least 0.1% at $8.38 an ounce. And June palladium was down to $14.65.90 an ounce. We're going to actually kind of take a look here, pause and take a look at the metals prices here as they scroll up here. We see gold there, did take that loss there, but it's up a little bit, recovering a little bit already, and slightly. And silver's $50.15. Platinum is down $1, and palladium is down $21 to $15.15. Very good here. So it's fascinating to see these numbers and see where the metals are going, and for why. Looks like China is the reason. Now, in this article from Kitco, Goldman Sachs sees higher gold, silver prices, and they're neutral on on the overall commodities. Goldman Sachs is turning lukewarm on the general commodity index, but the firm remains positive on gold and silver, increasing its forecast for the precious metals in its latest commodities report. In a report published Monday, commodity analysts at Goldman Sachs raised their forecast by $25 across the board over the next 3, 6, and 12 months. The analysts now see gold prices pushing $1,350, $1,400, and $1,450 an ounce, respectively. And I think this just goes to show you, kind of flies in the face of all this thing with the banks trying to suppress the price. You know, here they're kind of pumping up gold. Go figure. The negative gold real rates correlation has reemerged, with the gold rally closely tracking the fall in real rates. In our view, this switch in the gold rates correlation after the Fed paused reflects why this stage of the rate cycle is a sweet spot for gold, the analyst said. Higher rates can lead to more financial market volatility and recession fears, boosting safe haven demand for gold, while a rate cut boosts gold demand as it lowers opportunity costs for holding gold. Looking at silver, the investment bank raised its short-term and long-term forecast, up 25 cents. Analysts see silver prices rising during the next 3, 6, and 12 months to $16.50, $17, and $17.50 an ounce, respectively. That's rather bullish, I think, for sure. Not quite as bullish as gold is, but still, these are all targets that are surpassing my goals too. And I thought I had, or what my predictions were. And I'm going to hold to my predictions too. My predictions aren't quite as bullish. I was overly bullish last year, but we'll see how this all plays out for these targets, indeed. Although silver's industrial demand looks anemic going forward, Goldman Sachs is optimistic that silver will continue to rally in line with gold prices. At the same time, a high gold-silver price ratio should help incentivize investors to diversify some of their gold holdings into silver. The bullish sentiment comes at an important time for gold, which has been hit with a wave of selling pressure as investor optimism in equity markets has weighed on the yellow metal. Gold prices have dropped nearly 5% since hitting a 10-month higher last month. April gold futures last traded at 1,285.20 an ounce, down 0.18% on the day. So here we see the dollar to silver, the charts for silver, and there we see it, $50.10 there. It's actually now $15.15, and very good here. The silver market's defying gold's weakness, and the precious metal modestly up to the day. And that's basically because of what we talked about with China. While Goldman is optimistic that gold prices will continue to push higher, analysts are not optimistic on the overall commodity complex, saying that prices are no longer overvalued and need a new catalyst to push higher. From this point, positive returns will need to be justified by further evidence of improving fundamentals. The risk-reward of being outright long commodities is therefore less compelling now compared to a few months ago, and we recommend a neutral portfolio position in commodities. Very interesting indeed. All right. So there that is. Very cool. Very interesting indeed. And so it's fascinating to see how these all will line, how all these numbers line up, and where the future lies for gold and silver prices in the coming 6 and 12 months time periods, and the rally for gold because of gold's drop. The 7th straight day here in 2 years because of China, I think is quite fascinating indeed. It does provide a great buying opportunity if you have the funds to do so. But post your thoughts below about this news and about where you think precious metals are going. Do you agree with Goldman Sachs in this case? And very interesting indeed to see what your thoughts are on this. I want to extend a multitude of gratitude to y'all for watching and encourage you to please rate, comment, and subscribe.